Hello, and a very warm welcome to today's investment coffee break. Now, since the last video, we've seen a new monarch, 2 new prime ministers, and 3 new chancellors. So there's an awful lot that's happened in the last few months, because that was only just back in July. Today, I'm joined by 2 more of our investment managers from our Winchester office, Matt Lyth and Alice Proctor. Alice, perhaps I can start with you. There's such a lot that's happened. Can we have a quick recap?
Yeah, of course. So stock markets and bond markets continue to be in negative territory over the last year, which I'm sure won't be news to anyone. What you can see by this chart here is that actually both bonds and equities are not performing in the way that you might normally expect for recessionary environments that we are in at the moment. So bonds are not providing that hedge away from equities that perhaps they have done in the past, such as the global financial crisis or the dot-com bubble, for instance. So the main message here and answer, Andy, is that unfortunately the environment continues to be very challenging for all investors, even investors on the more cautious end. While we're seeing a little bit of relief over the last sort of month or so in equities and bond markets, the main relief that we're seeing over the last year is in our alternative allocations. So things like infrastructure, absolute return funds, for instance, they're providing that hedge away from equities that perhaps in the past we may have relied on bonds to provide. So I think it's important as well to touch on inflation. I mean, right now inflation is what's driving markets. So UK CPI is at 10.1%. What you can see here is that petrol and energy bills continue to make up a large part of this data. But what we've also got right now is an energy and petrol price cap. So that's going to go a long way at capping inflation. And the Bank of England actually expects inflation to come back down to sort of the 2% mark as we move into 2024. So they expect inflation to increase to sort of 14% as we move through the winter months, but then start tapering back down again, largely owing to this energy price cap, but also as we see tax hikes potentially come in and interest rates increase further, what we'll see is also goods and services inflation come back down as well. So the Bank of England actually expects peak interest rates to reach about 4.6% in order to allow us to get to that inflation target of 2%. And finally, I just wanted to touch on this last chart here. I think there's a lot of negative news at the moment in the media, and I think it's important just to look through that and focus on the figures that we have in front of us. So recessions aren't actually always all doom and gloom and mean the collapse in economies or mass unemployment that feature in our imaginations. They actually are a natural cleanse of the economy. This chart actually plots various different recessions and the shapes and the sizes of these recessions over a 40-year period and their impacts on UK GDP. And what you can see is that the Bank of England's forecast for the recessionary environment that we're in now is actually much more mild than perhaps the most recent recessions that we've seen. So while they're more mild, they may last, or this recession will last likely longer than what we're used to. So it's expected to last over sort of 5 consecutive quarters. Markets are actually pricing in an 85% chance of recession at the moment in the US. So there is an argument to suggest that we're actually near the bottom already, which is at least one reason to be optimistic. But it's just important to remember that recessions aren't always hugely negative, and they are actually a very important part of the economic cycle.
Thanks, Alice. I mentioned the political turmoil right at the beginning, and that's led to huge volatility in things like currency or the sterling against the dollar, but also UK bond markets and bond yields. Can we explain what that means and how that affects things?
Yes, of course. I mean, it has been a pretty busy month or couple of months in politics, particularly in the UK. And as we know, Liz Truss aims to stimulate the economy, and she did this with her mini budget and unfunded tax cuts. So bond markets reacted and sterling reacted quite negatively to this news. naturally, the mini budget meant that people would be able to spend more and increases demand, which increases inflation. So because of this, the market bet that the Bank of England would have to actually raise rates much more aggressively than they would have had to pre-mini budget in order to keep inflation under control. So with that, of course, with interest rates rising, naturally bond yields rise and of course bond prices fall. So that's what we've seen more recently. But actually since then, we've seen bonds begin to stabilize. And the reason for that then is obviously Jeremy Hunt and Rishi Sunak really tend to prioritize getting inflation under control much more than perhaps Liz Trussed. So that's been interpreted in a very positive way. So while we expect interest rates to continue rising, they won't actually have to rise quite so aggressively as they have done or would have had to have done so in the past. So, I mean, last week we saw the Bank of England raise rates by 0.75%, and the current rate is now at 3%. So a massive hike, but actually the tone is more dovish than before, as the governor confirms that they won't need to raise hikes to be expected 5.25% to bring back down inflation. What's expected is anywhere sort of between the 3 and 5%, more likely the 4.6%, which I mentioned earlier. So what you would have also seen as well around that time and around the time of the mini budget is the impact on sterling, and sterling tumbled as a result of that. And that's really just because people were very worried that, of course, the mini budget was very inflationary. The government were going to have to borrow more money, but also overseas investors became increasingly concerned that the UK government were going to default on their debts. Yes, that is bad news, of course, but actually we've got an overweight exposure to the US dollar in our portfolios, and also the allocation in the UK in our portfolios are very much international companies. They have overseas revenue streams, and so that again has helped hold up the portfolios and provide that hedge against sterling falling.
Excellent, thanks, Alex. Matt, perhaps I can bring you in talking about the large companies that we're investing and their international earnings. We've seen some of those larger companies release their third quarter earnings, and some of them haven't been great and have led to a reduction in their share price. Is that something we should be worried about?
Well, I think you need to look at the Q3 earnings report in a couple of ways. The first being the actual earnings themselves, and some companies have reported very, very strong earnings this quarter. Companies like ExxonMobil that have had the largest quarterly profit on record, and other companies have reported pretty poorly, in fact, seeing earnings decline. A company like Facebook as a good example. However, in aggregate, we've seen companies across the S&P 500 report increases in earnings. That means that revenue for Q3 has increased and gone up. And it's actually the case that earnings have increased throughout this year, that there hasn't been an earnings decline in the S&P 500 all year. So the share price performance is almost needs to be taken slightly differently, in that the outlook that these companies have been giving over this earnings period has been quite cautious and quite negative, due in most to the fact, as Alice mentions, that most of the world is expected to enter a recession next year. Amazon is a very good example of how the outlook can really impact the share price. I think on the evening that Amazon announced the results, they had a very cautious outlook for their fourth quarter, which typically is a very good quarter for Amazon given the Christmas period and Black Friday. However, Amazon share price on the night dropped as much as 20%, which I think wiped about $10 billion off of Jeff Bezos's personal wealth. So share prices are largely factoring in what's coming as opposed to what's been, and I think that's important when you look through these earnings.
Excellent. Okay, thank you. So what's our short-term outlook then, and how are we positioning client portfolios to benefit them and to exploit some of those opportunities that are out there?
Well, judging by what the companies are saying in these earnings updates, I think we're right to be slightly cautious in the short term with what's going on in equities. However, when you take a more medium to long term view and you look at where the valuations are at the moment, which as a result of earnings going up and share prices going down, that results in valuations across stock markets moving more cheaply. when you look at historical returns on the current valuation that the stock markets are suggesting, they are pretty strong. So the chart you can see here suggests that at the current level of the global stock market, annualized returns over the next 10 years are in excess of 10%. Now, obviously, past performance isn't necessarily a guarantee of future performance, but it's a very strong indicator that equities over the next 5 to 10 years could perform quite well. In terms of how we're positioned as a team, and as Alice has pointed out earlier, we are expected to go through a prolonged period of what could be and should be a fairly shallow recession. So it's probably not the right time to go overly optimistic and bullish on equities, but we certainly don't want to be underweight or reducing our exposure to equities at this point, given the opportunity of the market recovering next year. But at the moment, with inflation where it is and with interest rates still rising, that is a negative headwind for equities and bonds. And we probably won't see a turnaround until both inflation starts coming under control and we get signs that the central banks are going to stop raising rates and potentially start cutting rates into the recession. So from an equity point of view, we're fairly neutral, but at the same time, we've got an overweight position. We like to hold a bit more cash in portfolios than we otherwise would in a normal environment. That's because we think there will be rife opportunities to pick up equities at very good long-term valuations over the next 6 months. As Alice has pointed out as well, that the fact that interest rates are still going to rise into next year means that the headwind is going to remain for bond markets. Again, we're becoming more optimistic on bonds as the days go on, but we still remain underweight, i.e. we want to have less exposure to bonds generally than our peer group. And finally, again, as a result of inflation remaining fairly high and for the potential that inflation remains fairly sticky, we want to make sure that we've got a decent exposure, an overweight exposure to our alternative bucket, because that's the area of the portfolio that will provide good inflation protection and a hedge against stock market declines.
Thanks, Matt, and thank you, Alice. Thank you as well for joining us, and we hope you found that useful and that you can join us again for the next investment coffee break.